Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. I wanted to talk about the impending UK inflation report coming up on Wednesday morning. Certainly, I think this is going to be a bit of a curveball for many because whilst it's going to look like we could see UK inflation remaining stubbornly high, that is unlikely to be the truth. And I think we are fast approaching a period where we see a significant bout of disinflation, which has obvious consequences for the pound, the FTSE 100 and alike. So let's get into it. So in terms of a few of the charts that I've put together, first and foremost, I wanted to highlight the UK picture in terms of headline inflation in comparison to some of the other major economies. Certainly, we've seen a dramatic decline from the sort of double-digit figures that we were looking at the back end of 2022. But nonetheless, at 3.9%, we still stand well above our peers, and the likes of the Eurozone and the US are also ahead of things because, of course, we've seen the December numbers from both those countries. We are yet to see it from the UK, and that's exactly what we are about to see. So are we going to move anywhere near the 3.4% that the US is holding at the moment? That looks unlikely, quite frankly, but not all is lost. Let's look at the UK compared to the Eurozone, which is another factor when it comes to the economic outlook. The Eurozone continues to be in trouble in comparison to the UK. Certainly the composite PMI number of 51.7 in the UK stands in stark contrast to that 47.6. And really it's highlighted by the fact that whilst both of them are in contraction territory in terms of manufacturing, the UK services sector remains strong, well in expansion territory, and the over-reliance of the UK on services and the over-reliance on manufacturing within the Eurozone is in part why the Eurozone is suffering much more than the UK from an economic perspective. So the UK economy-wise is, looks like it's holding up well enough for the Bank of England to be able to hold off and drive down that inflation rate. And that does point towards potential strength for the pound as long as inflation is away from target. Now, CPIH inflation, we can see here the breakdown really does highlight where inflation has been coming from in the past, over the past year and a bit, and where some of that sort of been stripped out of late. Most notably, we can see that sort of big green section in the middle in terms of household services and housing costs. That really has been driven down in a meaningful manner. We're now looking at things like food and non-alcoholic beverages. We're also looking at restaurant and hotels as the two sort of main components. But as you can see, we are seeing that gradual shrinking across the board in terms of the sources of inflation here in the UK. In terms of the outlook for the Bank of England, markets currently pricing in the first rate cut here in May. So the 9th of May, we've currently got a 29% chance that we still see rates held at that meeting. For the rest of it, essentially 70% expectations, we're expecting to see 25 basis points cut or more. And then you look through the year and markets are expecting to see around 5 rate cuts coming into December. So by and large, markets are expecting May to be that first rate cut and for that to mark a consistent and persistent period of easing from the Bank of England. So are we likely to see inflation return to target before that May meeting? Well, certainly. Let's break down the headline number. Let's look at the core number and see whether that's likely. First and foremost, markets, we're talking about the likes of Forex Factory, the likes of Trading Economics, widespread economic consensus at the moment points towards a forecast around about 3.8%. So that would be a mere tick lower from 3.9%. And this is what I mean when I say that markets could get wrong-footed somewhat, because this would point towards us struggling to get back towards target anytime soon. If we're at 3.9% and we're only moving down to 3.8% this month, if that's what comes to fruition, it's not necessarily filling us with confidence that we're going to get down to 2% anytime soon. But if we look at what we're seeing from a sort of base effect standpoint, we're looking at this 0.4 or 0.37, as we can see on the left-hand side of the middle section, 0.371. That's being stripped out. If we look at the last number that we've just set, which is the November figure, minus 0.24. So whilst it's unlikely we're going to see that same kind of disinflation on a monthly basis because of the big move lower that we saw in terms of energy prices for that month in particular, certainly it's worthwhile noting that, if we see a figure 0.1, 0.2, something like that, that's likely to see that sort of move lower in terms of the annual rate. But what's more notable within this middle section really is the fact that as we move throughout Q1 and into Q2, we see these really big chunky figures start to strip out. And that's where you see the big disinflation take hold. Now, certainly if we're looking at, say, the bottom section of this chart, you're looking at the potential for where market expectation or where markets could see inflation at certain points in the year. So, for example, we've got the annualized 8-month annualized figure that essentially shows us where on the current trajectory we could see inflation by April time. That is 3.3%. So still above target. But as we get those really big chunky figures stripped out, you can see that the difference between where things could look in April and where things could look in May are very marked. You can see 1.66, well below that 2% target, is currently where we're heading by May. So that's why we can see a rate cut, that first rate cut coming at the May meeting. It does seem very likely because if you then annualize forward another month, so 6 months annualized, you're looking at essentially the last 6 months putting us on a trajectory to see a 0.578 inflation rate in terms of UK headline inflation. So certainly there's a fine balancing act, and if the Bank of England don't start to cut rates at the right time, they essentially could likely see inflation fall well below target. That's not necessarily the end of the world, given the fact that we've seen, UK inflation up to 11%. I don't think they're necessarily going to be too worried if we have a small period of time of below 2% inflation. But certainly in terms of where we hit that target, it does look like May is likely, and therefore market expectations appear justified. As we said, 29% markets pricing a rate hold at that meeting. I think it's likely to be much less than that. I think it does look very likely that we are going to see big disinflation. And also, let me just bring it back to worthwhile bearing in mind, whilst we're likely to see a small tick lower this time around, the January figure could be even more of a curveball because we see this big negative reading stripped out. So we're likely to see inflation rise next month. That, again, could really signal to markets that we're not going to hit that 2% and target anytime soon. Then all of a sudden you see these massive figures for February, March, April, May strip out, and we should get back down to 2% pretty swiftly after that. But certainly this month, and in particular next month, look particularly interesting from this perspective. In terms of the core figure, this is going to take some time to get back down to target. It's at 5.1%. Market's forecasting at 4.9%, as you can see on the top right. I've added that forecast section on. In terms of what we're seeing dropping out, we're 0.545. So a pretty chunky figure dropping out. And that's why we're seeing markets expecting to see that annual figure drop by a more significant amount. Certainly, we did see that negative reading last time around, but markets expecting to see less of a pullback in terms of the month-on-month reading this time around. In terms of where we're looking to be in April, May, June, even by June time, it looks like we're still probably going to be above that 2% reading according to these annualized figures. So current trajectory, if over the past 6 months puts us around about 2.4%. So above target, but quite frankly, if we're seeing the Bank of England faced with the prospect of a potential move back down to, 1% and things like that in terms of headline figure, I think that's probably going to be a big focus for them at the time. In terms of what this could mean for markets, let me just quickly bring up, let me just maximize this. Let me just bring up a couple of charts. Firstly, Euro Sterling. Euro Sterling, of course, we're looking at what's happening in terms of the ECB, and the ECB, I think, are likely to see inflation return to target soon enough. Two, we haven't necessarily heard the most dovish comments coming out of the ECB and the Bundesbank so far this week. But nonetheless, I think they're in a fairly similar position. In terms of this trend, we have this descending trend line. So 0.861 would need to break for this market to roll over. I don't necessarily think that we're going to see this market at the moment signaling that we're going to see this big drop down below 2% for the UK inflation figure, even if that is likely to be the case, as I said. So we could see some strength coming into the pound around this figure if people are just focused on the near term and worrying about what it means that we haven't seen a significant decline this time around. That could see this trend continue with a sort of move where it rolls off this descending trend line and continues this bearish trend that has been playing out thus far. The wider picture does point towards a possibility of another higher low coming into play soon enough, but whether that is going to happen this time around, I am not necessarily sure. I think there's a good chance we do have a potential another leg lower, and if we see markets focus on that wider picture, then we'd need to see that 86172 broken for that. I think probably more pertinent is this sterling Aussie pair. It's going to be an interesting one because you're looking at a market that certainly, if we see markets suddenly realize that we are going to see that 2% target hit soon enough, I think there is grounds for sterling to start to roll over. And certainly this market does look like it has topped out here. If we're looking at recent price action, this sort of head and shoulders formation, that recent breakdown through the horizontal support level that we have here, but then subsequently rallying back up into this descending trend line, the 76.4 Fibonacci level. So the potential for this to be a near-term top, but really it's also going to come down to what's happening in terms of price action itself. Certainly 1.898. If that breaks, it looks like we're going to see this market roll over. Until that happens, like I said, if we just see a very minimal move lower in terms of UK inflation, then potentially we do see some strength. But I think it's going to take a significant amount of time for the Australian inflation figure to come back down compared to the UK. I think UK is going to hit target before Australia, and I think that does point towards the potential for this to roll over. The question mark is, of course, over the near term, whether markets recognize that despite what looks to be a potentially somewhat underwhelming disinflation move. But it's worth bearing in mind that this month and next month, granted, it doesn't necessarily look like we're going to see a massive move towards the downside in terms of inflation. Certainly next month, we could see a rise. But I think soon enough, the rhetoric around where the Bank of England is going to be has to change. And certainly the tones coming from those Bank of England members will likely change with it. So keep an eye out for commentary from the likes of the Bank of England, because despite the fact that it looks like inflation could potentially just tick lower and maybe next time around move quite significantly higher, the wider theme and the wider trend, underlying trend, points towards a likely move back down to target before that May meeting. And that means that the Bank of England soon enough are going to have to really prepare markets for what is likely to be a significant dovish turn from the Bank of England in 2024.